Okay, chapter 20 is pretty short, so I should actually be able to finish it up in this lecture. So this is lecture 2 for chapter 20, which should be the last one for this, assuming it doesn't go too long. So I'm on page 1174. We're going to talk about correcting accounting errors. So when we find a mistake, what do we do? How do we fix it? What's the best method? Steps to correct accounting error. I'm on part B, 1174. Step 1, a journal entry is made to correct the account balances that are incorrect as a result of the error. Step 2, previous year's financial statements that were incorrect as a result of the error are retrospectively restated to reflect the correction for all years reported for comparative purposes. Step 3, if retained earnings is one of the accounts as a result of the error, the correction is reported as a prior period adjustment as to the beginning balance on the statement of shareholders' equity or statement of retained earnings, if that's presented instead. And step 4, disclosure note to describe the nature of the error and impact on of its correction on net income. So a prior period adjustment refers to an addition or reduction in the beginning retained earnings balance of the statement of shareholders' equity. Like we talked about in chapter 4. In an earlier chapter, we saw the statements of shareholders' equity is the most commonly used way to report events that cause components of shareholders' equity to change during a reporting period. Some companies, though, choose to report the changes that occur in the balance of retained earnings separately in a statement of retained earnings. When it's discovered that the ending balance of retained earnings in the period prior to the discovery of an error was incorrect as a result of that error, the balance must be corrected. When it appears the beginning balance the following year. However, simply reporting a corrected amount might cause misunderstanding for someone familiar with the previously reported amount. Explicit reporting a prior period adjustment on the statement itself avoids confusion. Assume, for example, the following comparative statements of retained earnings. So we have the statement of retained earnings for December 31st, 2017 and 2016. Now, what you can see on the second one is that we have separately put on there the prior period adjustment to show the correction of the error. Error correction illustrated. A really important point the book makes here on 1175 is that the idea behind this isn't memorizing how to do a certain adjustment, okay? Whether it's a depreciation adjustment, whether it's a maintenance adjustment, whether it's a fixed asset adjustment, doesn't really matter what it is. What matters more is that you know and understand how to correct this. Now, I kind of go off book a little bit here, but the way that I do this, and the book kind of does this as well, you'll see in illustration 2017, and they do it in illustration 2014 too. The way that I think is easiest to see how to correct an error is that I personally write out the journal entries for what actually happened, okay, what they recorded incorrectly. Then I write out the journal entries for what they should have done to show what should have occurred in the financial statements. And that way I can basically consolidate those into one journal entry and say, okay, this is the one entry that will correct all the errors. So if you look at 20-17 on 1177, you'll see it says, in 2018, internal auditors discovered that Seedman Distribution Incorporated had debited an expense account for $7 million for the $7 million cost of sorting equipment purchased at the beginning of 2016. The equipment's useful life was expected to be 5 years with no residual value and straight line depreciation. So here's where you can see how it should have been done, okay? So that's the correct journal entries. Those were not recorded, but the correct column there is how it should have been recorded. The incorrect entries, that is how it was recorded, but it is wrong. Notice it also says depreciation has been omitted. So now what I see is that my expenses are overstated because at least the expense for the $7 million was overstated. And my equipment was understated because it's not in my equipment account. But the issue here is I had depreciation expense that I didn't do for 2 years. So 2016, 2017, I had a debit to, or I should have had a debit to depreciation expense for $1.4 million in each year. That's a total of $2.8 million. So I need to make sure that when I adjust my retained earnings, that I adjust it by the difference between the $2.8 million worth of expense that should have been done and the $7.0 million worth of expense that was actually done. And I also need to debit equipment for $7 million to show that it's now on my balance sheet. And I need to credit accumulated depreciation. So if you look, it's not the easiest thing to visualize probably, but if you look and read that example carefully, you'll see that the correcting entry there effectively and it runs it through retained earnings for the additional expenses that shouldn't have been there. Effectively corrects everything all in kind of one fell swoop. Okay, it goes on to talk about errors, even errors that eventually correct themselves, cause financial statements to be misstated in the meantime. So example of that is something like cost of goods sold. Okay, if my inventory is either under or overstated, my cost of goods sold could be incorrect. And yeah, that'll eventually correct itself, assuming that I have recorded my purchases correctly and recorded my inventory correctly. But that still is putting the net income or the expenses, in this case, if it's cost of goods sold, into the incorrect period. So I'll still want to correct that when I find it, even though it will eventually correct itself. So let's look at brief exercise 20-10. So for $315 purchased on January 1st, 2015. So they debited an expense account of some kind. Well, but was the entry as it was actually done, but it's an incorrect entry. What should they have done? Well, they should have debited $350,000 and credited cash for and here is this was done in so they should have so value life is it value. So to figure out how much appreciation the asset minus residual value divided by, I know it's divided by useful life, so $70,000 a year, and be the same. Okay, so now I figure out what to correct. Well, first, so this actually did here, right? Don't need to mess with. Didn't have it first correcting it. That needs to be debited for 150. Now, that means that I have $350,000 worth of expenses, but expense, but expense. So net income wise, my three-year period, how much my actual record to, which means I have 100,000. Means that increase that by 140,000. So now, with this over here, this is taken by that. I'm not up. So now all I'm missing for 200,000. And this obviously was the green part, and that would be my correcting entry for a correction of error on depreciation. And I think that is it for chapter 20.